Investing can be a great way to grow your wealth over time, but it's important to do it wisely. As we enter 2023, legendary investor Warren Buffett has warned against several common mistakes that can hurt your investment returns. In this video, we'll outline the 5 worst things investors can do this year, based on Buffett's advice. And if you're interested in starting your own investment journey, you can use the referral link in our description to sign up for an account with Interactive Brokers, a reputable online brokerage platform. Before we dive into the 5 worst investment mistakes to avoid in 2023, it's important to note that investing always involves some level of risk. While there's no surefire way to guarantee investment success, there are strategies you can use to minimize risk and maximize potential returns. By taking heed of Warren Buffett's advice, you can make more informed investment decisions and avoid common pitfalls that can lead to financial losses. So, if you're ready to learn how to invest wisely, be sure to subscribe and hit the bell button for notifications on our future videos. 1. Messing up with emergency funds. Investors who are too eager to make quick profits may be tempted to use their emergency funds for investments, but this is a mistake according to Buffett. It is important to prioritize the emergency fund and not invest it in equities, no matter how profitable the market may seem. However, the market downturn in 2023 could lead some investors to overlook the importance of having an emergency fund and instead invest that money in the stock market.
The question is about diversification, and I've got a dual answer to that. If you are not a professional investor, if your goal is not to manage money in such a way as to get a significantly better return than the world, then I believe in extreme diversification. I mean, so I believe 98 or 99%, maybe more than 99% of people who invest should extensively diversify and not trade. So that leads them to an index fund type of decision with very low costs. Because all they're going to do is own a part of America. And they made a decision that owning a part of America is worthwhile. I don't quarrel with that at all. That is the way they should approach it, unless they want to bring an intensity to the game to make a decision and start evaluating businesses. But once you're in the business of evaluating businesses and you decide that you're going to bring the effort and intensity and time involved to get that job done, then I think that diversification is a terrible mistake to any degree. And I got asked that question when I was at SunTrust the other day. And if you really know businesses, you probably shouldn't own more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need. And you're going to
2. Mistaking diversity for diversification. Buffett cautions against mistaking diversity for diversification in an investment portfolio. Simply purchasing various stocks from different companies and sectors does not provide true diversification, as investors are still solely invested in equities and vulnerable to the movements of the stock market. Instead, investors should diversify across a range of investment opportunities, including equities, gold, real estate, and other options, rather than solely investing in one type of stock or investment option.
desire of people to gamble, and they gamble in stocks, incidentally, too. Day trading, I would say, very often came very close to gambling as defined.
3. Trade too frequently. Buffett warns against the risk of owning stocks when investors make certain mistakes, as he wrote to Berkshire Hathaway shareholders in 2015. One of the key mistakes he identified was active trading, or trading too frequently. Selling stocks too soon can lead to a reduction in total returns, which is why Buffett's preferred holding period is forever, even though he doesn't always hold stocks for an extended time. Additionally, buying stocks too often can be problematic, and he advises investors to only purchase stocks in 2023 if they are available at an attractive price compared to the low end of their earnings projections over a period of 5 years or more.
That I've known maybe a dozen people in my life, and I said there are undoubtedly hundreds or maybe thousands out there, but I've said that I've known personally a dozen where I would have predicted, or did predict, in a fair number of those 12 cases, I did predict that the person involved would do better than average in investing over a long period of time. And obviously, Charlie is one of those people. So would I pay him? Sure. But would I take financial advisors as a group and pay them 1% with the idea that they would deliver results to me that were better than the S&P 500 by 1%, and thereby leave me breaking even against what I could have done on my own? There's very few. So it's just, in the field of investment, that it just sort of passes along. And $10 billion, I mean, $200 million fees. We've got two guys in the office, that are managing $11 billion. No, they're not. I'm sorry. They're managing $20 billion. Between the two of them, $21 billion maybe. We pay them $1 million a year, plus the amount by which they beat the S&P. They have to actually do something to get contingent compensation, which is much more reasonable than 20%. But how many hedge fund managers in the last 40 years have said, I only want to get paid if I do something for you? Unless I actually deliver something beyond what you can get yourself, I don't want to get paid. It just doesn't happen. And
4. Pay too much in fees. Paying excessive fees to investment managers is a mistake that Buffett cautions investors against, as it can be akin to death by 1,000 cuts. He has expressed his disapproval of high fees in the past, noting that many advisors prioritized generating fees over generating high returns for their clients.
Smart person that's reasonably disciplined in how they look at investments can get in trouble is through leverage. I mean, if somebody else can pull the plug on you during the worst moment of some kind of general financial disaster, you go broke. And Charlie and I both have friends where that's happened to them. But absent leverage, and absent just kind of going crazy in terms of valuation on things, the world won't hurt you over time in securities. And, you won't be subject to the financial cataclysms that they don't need to do you in. If you have any more money during periods like that, you buy.
5. Use leverage. During a CNBC interview in 2018, Buffett discussed the 3 ways a smart person can go broke, according to his partner Charlie Munger: liquor, ladies, and leverage. Although the first 2 were only added for the sake of alliteration, Buffett believes that using leverage is the real culprit. He cautions that borrowing money to invest in stocks can potentially erase any gains an investor may have earned.